Now we're ready for number 4. And number 4 is kind of challenging, but it's still lots of fun. Here's a scenario. You've got that kind of laid out. Now what's interesting about that is they give you 2 periods of numbers. You've got assets and liabilities for May and assets and liabilities for June. And they don't give you owner's equity. What you're going to have to do is figure out owner's equity and then apply these scenarios to find the net income. And that sounds really scary, doesn't it? Well, it's not if you set it up right. So here's how the template works for you. As soon as I find the template, it went away. There's the template. Okay, let's just take all of this away because I was playing with it. This is what you're going to see. So there's 2 things you have to do here first. First thing is you've got to figure out the owner's equity at the end of May 30th. And to do that, you take 174 minus 108, which is the ending. This is the ending, and this is the beginning. So, I'm sorry, this is the assets minus the liabilities. And I believe that's 70,000. Or it better be. And we know that's true for all 3 of these scenarios. So let's just plug that number in right now, because you're going to need it all the way across the board. That's our beginning inventory. Now, let's come down here and figure out our ending inventory, which is 208,000 minus 127. Again, assets minus liabilities. This comes up to 81,000. And we're going to pop those in all across the board. And the next, this is the fun part. We have to figure out how that $70,000 got to 81,000. There's only 4 things that affect, in this particular situation, 4 things that are going to affect the owner's equity account. First one is going to be investments by the owner, if they buy more stock or they put out more stock. The next one would be net income or a net loss, whichever. And the final one is going to be withdrawals or dividends, okay, by the, and you could say dividends here. It could be dividends or a withdrawal by an owner. Those are the only 4 things that will affect owner's equity. So let's see what happened here. They give us a scenario and they said, well, they bought or they sold $5,000 worth of stock. So they added $5,000. Okay. That still doesn't, and there's no withdrawals or dividends. Now, how do I get from $75,000 to 81,000? Well, I'm going to add these 2 together, right? That gives me 75. So I must have $6,000 in net income. See, I've added these 2. I have 75. I need 81,000. The only possibility, since there's no dividends or withdrawals, is that net income was $6,000 for this one. For the next one, okay, we've got 70,000. This is our scenario. Same as before, but now they've paid out dividends of 14,000, which is a withdrawal. So this is now in a negative state. So how in the devil do I get from 70,000 to 81,000? Well, this was deducted from the whole thing. So let's use this as our base. If I deduct 14,000 from 70,000, I end up with $56,000. To make it, or to even out that equation that we've been working on, I have to subtract that 56,000 from the 81, and that comes up to I need a grand total 25,000. So that means our net income was most likely, or is, $25,000. And let's see if that's true. Well, I've got 75,000 plus 25,000, which gives me 95,000, minus 14,000 gives me 81,000. I'm going to let you do the next one. And the next one, now I'll kind of give you some help. They issued $15,000 worth of new stock, so they got 15,000. That increased 15,000, and they paid dividends of 28,000. So how do we get to that 81,000? What becomes the net income? I'll leave you with that one. Okay, let's, that was fun. Let's go down and look at 5. And 5, I think, oh, I better go look and see what the problem is for 5, huh? We lost it. Well, that's not very good. Hold on, let me stop this thing so we can figure out what. I found it. It was hiding in another browser. So number 5 is asking us to evaluate the following effects on the accounting equation. Now, this sounds kind of scary again too, right? So, can you give me an example of an increase of an asset and a decrease of another asset? One thing would possibly be I bought supplies using cash. Cash that's a decrease, right? And I bought supplies, that's an increase. So you can kind of see how those transactions work. How about a decrease of an asset and a decrease in owner's equity? So what are the 4 things that decrease owner's equity? That would be, well, think about that. We just talked about that. The 4 things that decrease it are withdrawals by the owners or dividends, or a loss. Well, a loss is not going to show up in an asset account. I mean, that's going to come through the income statement. So there must have been a dividend. So we know the dividend's going to decrease the equity, and we're also going to have to pay that out in cash, right? So the cash would decrease when we pay it. So paying a dividend would be an example. Kind of get the gist of this? So how about a decrease in asset and a decrease in a liability? Well, an asset and a liability. Okay, accounts payable was in a liability, and when I pay it down, it goes down, and when I pay it, I have to use cash, which is an asset. Kind of getting a feel for this? So an increase in an asset and an increase in stockholders' equity. Again, go back and figure out what were the 4 things that increased stockholders' equity and go from there. I'm not going to do the last 2 for you. An increase in an asset and an increase in a liability. How about when you buy something and then you put it on account? So figure up some accounts for that one. That's number 5. And that worked rather, that makes kind of sense, right? So let's look at 6 now. Now 6, we're going to start looking at actual transactions that go into a grid. So let's go see what we have up here for number 6. Number 6 is more of the same, only now they're giving you the transaction. And you're going to use A, right here, as an example. What is this? This is an increase of cash. They receive cash, and an increase of stockholders' equity because they issued common stock. So you're going to look at each one of these and you do the same thing. Is this, we earned video rental revenue on account. Well, that's going to be an increase of a revenue account, which means it's going to increase the owner's equity, and it's going to be an increase in a receivable or an asset because they put it on account. And you'll go down, how about you purchase office equipment or office furniture on account? Well, let's see, I'm on account. I'm probably increasing accounts payable, which is a liability. And I'm increasing office equipment or office furniture, which is an asset. So kind of ferret down through those and transfer them to the template. 7. Now 7, you're literally just going to explain what's going on. You've kind of looked at all of these from above in one shape or the other, okay? Now you're going to describe. Let's see. For the first one, I'll give you a hint. We have received $23,000 in cash and sold or issued $23,000 in common stock. That becomes our business transaction. The second one, this is an increase in retained earnings, and we've got an increase in accounts receivable. This is revenue. Remember, we had this one right here, earned rental revenue. This is the same thing. So you're going to explain those. You're going to describe those as you go down. Email me if you need trouble. I have trouble with that. Let's look at 8. How many more do we have? I think I better end it right here for this one. I'm at 11 minutes, and I'll start another one, and we'll start up on 8 next time. Okay?